Looking at this economic survey document, the top-line data shows India maintaining a projected GDP growth of up to 7.2%, alongside a record-breaking $825 billion in total exports. To maintain that level of output, the economy requires a constant, massive influx of capital. Banks act as the distribution network, pumping that financial fuel into the sectors that actively drive growth. But distributing that capital in India presents a unique mathematical challenge. You have multi-billion-dollar tech conglomerates operating in global hubs, existing alongside citizens who require microloans to buy seeds or repair thatched roofs. A traditional monolithic bank built to underwrite corporate shipping fleets cannot efficiently process $50 agricultural loans in remote districts. The overhead costs and risk models simply clash. To solve for this extreme demographic diversity, India abandoned the one-size-fits-all approach. Over the last few decades, it built a highly specialized, multi-tiered banking ecosystem. At the absolute top of this hierarchy sits the Reserve Bank of India. The RBI never opens an account for retail customer. Instead, it dictates monetary policy, controls inflation, and acts as the supreme regulator for every other financial institution in the country. Beneath the RBI, the system immediately splits into two primary categories: scheduled and non-scheduled banks. Institutions listed in the second schedule agree to strict regulatory oversight, gaining direct access to central bank loans at favorable rates and the ability to seamlessly clear interbank transactions. The vast majority of these scheduled institutions operate as commercial banks. Whether they are public entities like the State Bank of India, private corporations like HDFC, or foreign branches, their primary objective is generating profit by moving high volumes of capital. Because commercial banks optimize for profitability, they naturally gravitate toward urban centers and larger businesses. This leaves geographic and social voids where formal credit struggles to reach. To fill those specific voids, the government engineered regional rural banks and cooperative banks. They operate with lower overhead and a distinct mandate to deliver affordable credit directly to village-level enterprises and farmers. On the opposite end of the spectrum are development banks. Rather than processing daily consumer transactions, institutions like NABARD exist to inject long-term capital into massive infrastructure projects and international trade. Recently, the RBI introduced differentiated banks to target hyper-specific needs. Payments banks facilitate digital remittances and small savings. They cap deposits at 1 lakh rupees and are completely forbidden from lending. Meanwhile, small finance banks bridge the gap between rural co-ops and massive commercial lenders, bringing formal savings and credit mechanisms to unbanked populations and micro-enterprises. This intense categorization means every financial action has an optimized mechanism: a multi-billion-dollar highway project and a street vendor's digital transaction run on completely different, purpose-built engines. With dozens of bank classifications issuing millions of loans at varying levels of risk, the central bank has to prevent the system from over-leveraging and collapsing. The primary mathematical defense is the capital adequacy ratio, derived from international Basel norms. It forces banks to hold a strict amount of highly reliable capital in reserve, directly proportional to the risk profile of the loans they issue. While global minimums sit around 8%, Indian regulators mandate 9%. Right now, scheduled commercial banks in India are operating with a ratio of 17.2%, providing a massive buffer against economic shocks. This bar chart illustrates the impact of priority sector lending. By requiring commercial banks to dedicate a percentage of their credit to specific social targets, we see a nearly 22% year-on-year growth in credit flowing to micro, small, and medium enterprises. These aggressive capital requirements and lending quotas create a highly resilient system. While global markets have repeatedly faced severe liquidity crises, the Indian banking sector has consistently maintained profitability and stability. The result of this strict oversight is measurable. Gross non-performing assets, loans that have gone bad, have dropped to their lowest levels in decades. Now, the industry is transitioning away from physical branches. Neobanks and digital banking units are processing transactions and issuing credit without maintaining a brick-and-mortar footprint. At the center of this digital acceleration are the domestic systemically important banks. These are institutions so massive and interconnected, like SBI and HDFC, that they are required to hold even higher capital buffers to guarantee systemic survival. every time you scan a UPI code at a market or open a fixed deposit on your phone, your transaction is instantly routed through this highly calibrated architecture. By abandoning the rigid, single-tier banking models of the past, India engineered a highly regulated, modular financial network. This architecture provides the exact stability and credit flow required to push the country toward a $5 trillion